So here you are in Canada thinking about your investing strategy for 2025, and I'm sure there are a lot of US stocks on your list. There are plenty of reasons why we should be investing in the US stock markets even if we are in Canada, but there are lots of things that we should know about before we start doing that. And it's obviously very possible that you have already been investing in the US stock market, but you may not be aware of everything that you should know of. Even though in this video I'm going to talk about everything from a Canadian's perspective investing in the US stock markets, these can be applied for anybody living in any other country as well. Basically, these are some things that you should keep in mind when investing in international markets. As usual, nothing in this video is financial advice. I'm just a guy on YouTube sharing some information that you might find useful. Let's begin. So let's start with the first tip. You have to take investing in the US stock market very seriously. This is because of three different factors. The first is the market size, the second is liquidity, and the third is growth. The US stock market is unparalleled in its size. It is over 10 times the size of the Canadian market and offers superior liquidity. This means it's easier to enter and exit positions. Also, there are several different options to invest in those markets. You get access to some of the global leaders like Apple, Amazon, and other major tech companies, but also you have access to several other sectors. So this is not a secret. Some of the largest companies in the world are located in the US. Some of the fastest growing companies, some of the most innovative companies, some of the most impactful companies, all are located in the US. The growth has a very strong momentum and it is expected to continue further into 2025 and beyond. So at its core, if you're not investing enough in the US markets, no matter where you are, you're missing out on a lot of opportunity, especially when it comes to growth, something we'll talk about in a bit. If you look at the performance of the S&P 500 over the last several decades, it is undefeated. If you really want to look at the risk-reward ratio, investing in the US stock market might be the safest option. Of course, this could be subjective based on some other factors that we'll look at in a bit. But the first and the main tip here is that you should be investing in the US stock market no matter how small or large your position is. But deciding what you're going to be investing in requires us to assess several other factors. This starts with tip number 2, that is understand dividend differences. The US markets generally offer lower average dividend yields compared to the Canadian markets. Consider this when building an income-focused portfolio, especially if dividends are a priority. Canada has quite a few large companies that are quite stable in nature and pay out quite high dividends. Here are some examples of the companies that pay considerable dividends. Of course, in the US also you can find several stocks that pay high dividends. However, investing in the domestic markets is always easier. So when it comes to building out your dividend portfolio, you might want to start by looking at the Canadian market first. Look at it properly and understand what you are investing into. Generally, I believe that high dividends are a trade-off for innovation. If the company is paying out high dividends, it might be coming at the cost of lower innovation because they are taking the money and giving it to you instead of putting it back into R&D. This is not always the case. You can just look at the example of Google, which recently started paying dividends. The reason I brought up the example of Google is because there's also a factor of taxes when it comes to dividends. There's a 15% withholding tax that applies to US dividends. So there's a difference in the taxation when it comes to these dividends. However, it depends on the accounts you're holding these dividend stocks in. So the account types are very important, but this is something that we can discuss in a bit once we have looked at some other factors. This brings us to the next step, that is you have to evaluate growth opportunities properly. Again, it's no secret. The companies in the US are the global leaders when it comes to innovation and growth. The track record shows that US companies have very strong corporate earnings growth. This is expected to be the same in 2025 and beyond as well. Even when it comes to Mag 7 companies, they may see slower but still considerable growth. If you are in Canada, you know that Canada is not known for innovation. The environment is just not there. There aren't even enough tech companies in Canada. If I had to think of a company, the only company I can really think of is Shopify. Unfortunately, I don't see any other growth companies in Canada right now, and even if there are, it's hard to beat the US markets when it comes to growth. There are definitely some good startups in Canada, however, that's not something you can invest in. So when it comes to investing, you have to look towards the US market again, especially if you need access to growth. Let's see what happens in the future if the government actually creates an environment where more companies pop up and they actually do well in Canada. The next tip that I want to share is to always account for currency conversion. The Canadian dollar has been suffering a lot against the US dollar in the last couple of months. And if you were invested in the US markets, you have actually made a lot more money than being in the domestic markets. Even apart from that, when you're investing in the US market, you have to account for the currency conversion rate and the fees that many brokers are charging. They might be charging anywhere from 1 to 2.5%. Try to look for brokers offering competitive forex exchanges and factor in the CAD USD exchange rate fluctuations always when buying any asset. There are also lots of brokers that offer US dollar accounts where you can keep a lot of US dollars to buy the stocks. So if we find ourselves in a situation where the Canadian dollar is stronger against the US dollar, we should be buying as much US dollars as possible to keep it and buy the US stocks later. There is something known as the Norbert's Gambit that you might want to consider for larger amounts. I don't do it, but it is legal and you might want to consider doing this once in a while. The next two tips are quite closely related and something that I've already touched upon, and it's got everything to do with taxes and selecting the right account types. Let's start by looking at the tax implications of investing in the US stock markets. Generally, when it comes to the buying and selling of US stocks, they are taxed exactly how other stocks in Canada are taxed. But as you guessed it, the main difference is when it comes to dividend paying stocks. There's a 15% withholding tax when it comes to dividend paying US stocks. However, RRSPs are exempt from this. This is because of a tax treaty that exists between the US and Canada. This provides protection against the 15% IRS withholding tax on dividends. Other than this, there are no tax implications on buying any other US stock in Canada. However, once your cost basis has gone above $100,000, there are some other tax obligations that you might want to fulfill. This has everything to do with declaration of foreign assets rather than really taxation. Now, there are no indications that any of these rules are going to change anytime soon. However, let's see what happens in 2025 because we definitely have a lot of unknowns going into this year. Honestly, let's look at where the new tariffs and trade policies take us. The next step, as I had mentioned, is very closely related, and that is selecting the appropriate account types for these investments. As you might have already guessed, if it's a US dividend paying stock, you should be holding them in your RRSP accounts. When it comes to other stocks, there's no right or wrong approach. However, I can share some of my learnings with you. Firstly, any growth stocks, especially in the tech sector, I hold in my TFSA because they have a lot of potential to grow and I really don't want to pay any taxes on them in the future. As you know, any growth in the TFSA is not taxed for entirety of your life, so they are quite safe there. Now, when it comes to buying the S&P 500, I consider that buying VFV might be the best option because it has no tax implications and it keeps things quite simple. However, there's also the option of buying something like the VOO in your RRSP to save any of the dividends that might be withheld. There's one thing I want to talk about. My general strategy was that I'm going to hold all the Mag 7 and big tech companies in my RRSP and TFSA. However, this year I've changed my mind a bit. This is mainly because last year Google started paying dividends and I had a lot of Google stock in my TFSA and I ended up losing some of the dividends because they were being withheld by the IRS. If I had the foresight to consider that Google might start paying dividends one day, I would have held all of them in the RRSP accounts itself. These are some things that you should keep in mind as well. Think about it, what's going to happen with these companies in the next 5, 10 or 15 years. For example, one day Amazon might start paying dividends as well, so we might be safer holding them in our RRSP accounts. You can enjoy the growth but also save on the dividends when they finally come along. When it comes to investing in very risky companies, for example, I hold Robinhood, I generally hold them in my trading account. Because generally I don't know when I'll sell them. I might sell them in 3 to 5 days or 3 to 5 months, and I don't want any hassle of day trading when it comes to my registered accounts. There are obviously many different ways you can structure your holdings, but generally try to keep your dividend paying stocks in your RRSP. Other than that, it's really up to you. Do whatever you feel comfortable doing and do whatever makes sense for your portfolio. Talking about your portfolio brings us to the last tip that I want to share with you, and that is your portfolio allocation. Many experts recommend a 50-50 split between US and Canadian investments. On the other hand, you have some experts saying that 30% should be in the US markets, while others say that 70% should be in the US markets. At the end of the day, what's important is to maintain balanced exposure to both markets, diversify across sectors and market caps, and consider that small and mid-cap stocks may present attractive opportunities in 2025, so you might want to look a little more towards the US markets. When I started investing, 50% of my investments were in Canada and 50% were in the US. That later changed to about 70% in the US. But the growth of those companies has been so high that I actually ended up with 95% of my investments in the US market at this point. This year, I'll see if I really want to balance it out. However, so far it doesn't seem like that. I think I'm just going to increase my holdings in the US because I believe that that's where the growth is right now. The Canadian economy, the Canadian government, and generally Canada is not doing well, and it's no secret. Everybody is aware of it. If I start feeling optimistic about Canada and the Canadian economy and the markets, that's when I'll try to pivot a little more towards Canada. However, there are some companies like Manulife, which is based out of Canada, which has done extremely well for me. So I guess it's not all bad news when it comes to Canada. However, we all know things are quite messed up right now. On the plus side, we are starting to see some signs of hope. I want to end this video by talking about why it's so crucial to be investing in the US markets in 2025. There are 5 main reasons for it. The first reason is that the US has continued leadership in global economic growth. We are also seeing strong corporate earnings potential, especially when it comes to the large companies. You will also get access to the world leading tech companies in the world, which is impossible in any other place right now. Now, you might be wondering, what about the emerging markets like China, India, and even South America? I agree that there are several opportunities in these emerging markets as well. However, when it comes to risk reward, US might be the leading one. Then generally speaking, you need to consider the diversification benefits against the domestic market risks, which are quite plenty right now. And finally, you have to consider the potential benefits of the US dollar. The last one was so important for us last year. We lost so much money just because the Canadian dollar was depreciating so quickly against the US dollar. There's also one more thing that I quickly want to talk about. If you don't want to overcomplicate things and you don't want to decide what to buy and what not to buy, consider at least investing in the S&P 500. It's a self-balancing tool that has proven itself over and over again over the last few decades, and you might want to benefit from this. The Canadian market actually used to keep up with the US market, however in the last decade it hasn't done so well. We all know whom to blame for that, but let's not talk about it today. So anyway, those are all the things that I wanted to talk about in this video. Hope these tips were a little helpful. I'll see you next week in a new video. Till then, keep learning and stay on top of your finances. Until next time.